Okay, welcome class to our very first ever online session of Accounting 202. I'm your host, Dr. B, as always. I wanted to first, of course, talk to you all about the situation at hand. As you are aware, UDC has transitioned all of our classes to an online format, given the recent health situation. And in this, we are going to have a few minor modifications to our policies. So normally, as you know, in the classroom, I would pass around the attendance sheet. However, obviously, I can't do that from where I'm at. But so what we're going to do, instead of having attendance being a part of your participation grade, what we're going to do instead is I've reopened up the discussion boards. So in every week, as you've been going through the learning modules, right now we're in module 5, which is after the midterm exam. And then every week you notice, well, I should say every week, almost every week there's a discussion board. So when you're going through each module and you're looking at the learning objectives and the things that you need to do for this week, in instructional materials, as always, you'll find the PowerPoint presentations and any additional videos that I posted. But which, by the way, at this point in time, I think it will be really, really helpful if you do watch these videos, just because it gives you that additional content perspective. In the learning activities for each week, you'll notice that there's a discussion board, the quiz, and the homework, as there normally is. With the discussion boards, instead of these being optional, these are now going to be required. And the reason why is because I need to have a way for us to all participate in the class. Because we're limited with technology for some students, and there's going to be some times where we simply won't be able to meet like this. In those situations, we still want all of us to be able to participate in some way, shape, or form. So now, instead of having the participation being graded by your attendance in these forums, they will now be substituted with the discussion boards. So now every week from this point forward, the discussion boards are now required. Does that make sense? Are there any questions or concerns about that?
No.
Nope.
So we should just go to the discussion board and write our names, or what?
Yeah. So what what you'll be doing is you'll be answering the discussion question in each discussion board. So here it says this, for example, for chapter 22, it says describe a non-manufacturing business that could benefit from the use of standards. Also explain how standards would help that business control its operations. To answer that question, of course, you'll need to read through the chapter and also review the PowerPoints for that chapter. So all I'm looking for here is a response to that discussion question. Does that make sense?
Yeah.
Great. So in other words, that'll be our requirement for grading participation, because again, not everyone's going to be able to make these online sessions, and so in order I don't want to penalize anyone for not being able to make these sessions because of the technology limitations. So instead of that, the discussion forums is a better way for us to monitor participation. I hope that makes sense to everyone.
Yeah.
Yes. Great. Thank you so much. And again, everyone, I really appreciate your willingness and your fortitude to do this stuff, because the reality is this is a difficult time for all of us. We're all experiencing these challenges, and so it's good that we're able to do this together. So somehow Valerie took my presentation from me. I don't know how that happened, Val. What did you do, Val?
All right.
It's okay. I got it back. Okay. So great. I'm glad that we're all clear on that. So today, what I want to do is I want to go through chapter 22, just as we normally would in class. So if you all wouldn't mind muting your microphones, just to eliminate the background noise while we go through the presentation. When you have questions, just unmute yourself and ask the question. It's just like it is in class, right? So if you have a question, just unmute yourself and ask your question, and then I'll be able to answer your question that way, because I'm sure some of your classmates probably have the same question or very similar. Does that make sense to everyone?
Yes.
Great. Awesome. Thank you so much. Okay, so let's go ahead and roll through chapter 22. Everyone can see the PowerPoint presentation, correct?
Yes.
Great. Okay, so let's go ahead. All right, chapter 22. I'm going to do it just like I normally would in class. Okay. All right, so in chapter 21, when we left off, a lot of it was surrounding cost and standard performance. Chapter 22 really builds on chapter 21 from a cost perspective. So in chapter 22, we're really looking at the variance from standard cost. And it's been a while since we've had class again. It's been about 2 weeks. So, and I'm sure most of us don't remember what happened in chapter 21. So you might want to go back, just kind of get yourself a quick refresher just by going through the slides. Okay, so let's talk about what standards are. Standards are, in accounting, standards are performance goals. We look at standards from a lot of different areas. Like a standard in life might be, I wash my hands every day. That's a standard that I have in life, right? And so as long as I wash, my goal is then washing my hands every day. So if once I do that every day, it becomes a standard. In accounting, the standards are performance goals of the business. So one goal might be, I'm going to manufacture 10,000 units every week. That then, since that's my goal, that then becomes my standard for the business. Manufacturing companies normally use a standard cost for each of the three following product costs: direct labor, direct material, and factory overhead. So going back to my example, if my company wants to manufacture 10,000 units per week, the direct materials cost will be the cost of those 10,000 units per week. The direct labor will be the amount of labor I need to use to create the 10,000 units per week. And the factory overhead will be the amount of overhead I need to use to create my 10,000 units per week. Does that make sense?
Yes.
Great.
Makes sense, yes.
Awesome.
Valerie says she can't hear anything, Professor.
I can hear now. I can hear now.
Okay.
I had to call that number, so I can hear now.
Okay. Good to hear. Thanks, Phil. Awesome. Okay. So going to our standard costs, as we had said, setting standards, we relate back in terms of cost and accounting. We talk about the standard cost for direct labor, direct materials, direct labor, and factory overhead. So the accounting system uses those standards for product costs. We call those standard cost systems. Standard cost system enables management to determine how much I should be producing to get to those standard costs and how much are the actual costs, right? When the actual costs are compared with the standard costs, the exceptions or variances are reported. So think of it from budgeting. We talked about budgeting back in chapter 20 and 21. And so when we talked about budgeting, we talked about the differences between the actual versus the expected, right? And so in that situation, if I budget $1,000 a month for my electric, and for that respective month I come in at $980, the variance is $20. The variance is the difference between the actual and expected. And so we can say the same for the standards when it comes to standard cost. So if my standard cost is, I'm producing 10,000 units, okay, and per week, and during that week I come in at we'll say 9,980 units, the difference is 20 units. That difference in 20 units is what I call my variance. So when you see the word variance, think of the difference between the actual and the expected. That's what we call a variance. Does that make sense?
Yes.
Yes.
Oh, fantastic. And then
Quick question, Mr. B.
I'm sorry?
Quick question. So
Yes, go ahead.
Can you have standards for sales, or is it only for manufacturing?
It's only for direct materials, direct labor, and overhead. You can have standards for sales, and I think we do talk about that in a little bit in this chapter. And it looks a little bit different. The standards for sales are really more like sales projections. And so if the company continually hits those sales projections on a regular basis, then it becomes a standard. Does that make sense? Yes?
Yes, it does.
Yes.
Great. Awesome. Thank you. Okay. So the reporting by the principle of exceptions allows for management to focus on correcting those variances. We as managers, when we see that there's a difference between the expected and what actually happened, we want to try to adjust for that in the future to correct for those variances. We'll talk a little about that here in a second. So as we just talked about, we want to set standards for our direct materials, direct labor, factory overhead, and some other areas as well, like expenses. We'll talk about that in a future chapter. We want to set standards by doing that. So the standard setting process includes joint efforts of accountants, engineers, and other management personnel. Earlier in the class, I talked about do you remember the example I gave in the budgeting chapter when I had discussed my experience in the hotel business? And I said that each department manager needs to provide me with their budget. The same concept applies when we set standards. So really, when we set standards, we want to include everyone at the managerial level for each department. And so they'll tell us what their standards should be or what they think their standards should be. And so that'll help us to really set the standards for direct materials, direct labor, and factory overhead. So from this slide, from the example gives us an engineer will aid in the operation with managers to set the standards for materials, labor, and machine requirements to produce a product. Now there's standards, and then of course there's ideal standards, which of course are just oftentimes difficult to meet. Think of the word ideal as being like perfect world situation, a perfect world scenario. So an ideal standard or theoretical standard are standards that can be achieved only under perfect operating conditions, such as no idle time, no machine breakdowns, and no material spoilage or material defects, if you will. So ideal standards is kind of like a perfect situation, perfect situation where I have the exact amount of materials, the exact amount of labor, and the exact amount of overhead that I need in order to produce the exact amount of, of products every single week. But we know in the real world, that's certainly not usually ever the case. So these type of standards, well, like if we have ideal standards, sometimes they have a negative impact on our performance because they can be viewed by employees as being unrealistic. Earlier, you had mentioned this concept of sales. So with sales, if I set my employees' sales goals too high, the employee will probably never be able to reach those sales goals. And so by setting sales goals too high, I'm making them unrealistic. I could do the same thing in manufacturing. Like if I set my expected number, like my 10,000 units that I want to manufacture every week, if that number is too high, and there's going to be times where I won't be able to meet that number because there's machine breakdowns or the raw materials, something wrong with them. You know, I won't be able to hit that 10,000 units per week. In that situation, which is my ideal standard, the employees will see that as being unrealistic. Does that make sense?
Yeah.
Hmm?
Great.
Yeah.
Okay. So in addition to that, we have what we call currently attainable standards. These are actually, most of the time, I call these normal standards. For some reason, your book doesn't think it's sometimes. Most of the time, these are called normal standards, okay? So with normal standards, these are standards that I can attain with a reasonable effort. So if I want to make my 10,000 units per week, I should be able to do this regularly. These are my normal. That's my normal goal, right? And so in order to do that, my normal cost would be the direct labor, direct materials, factory overhead costs that I know that I can attain to reasonably make my 10,000 units on a regular basis. So these standards are used by most companies that they allow us for the normal production without difficulty or mistake. So the reasonable standards are used for employees to focus on, and the costs are more likely to be reached. So going back to my example of the 10,000 units, in order for me to get my 10,000 units, I'm going to need, we'll say, for example, $5,000 in direct materials, $5,000 direct materials, $2,500 in labor, and then another $2,500 in factory overhead. And those combined, I'm able to reach my goal to create my 10,000 units at we'll say $1 per unit, just as an example. So periodically, we as managers, we need to look at our standards, and we need to, it's what I call an iterative process. Iterative means continuous. So we need to continually review and revise our standards as we go along. Because as we know, the cost of direct materials will change periodically. The cost of direct labor will change periodically, so forth and so on, right? And so because those costs continually change throughout time, I also need to update and revise my standards. And so, having said that, of course, we need to update and revise periodically. When we're looking to revise our standards, we need to look at prices, product designs, labor rates, and manufacturing methods that change periodically. So when you're managing this type of stuff, you want to look at it from that perspective of when something changes in direct labor, direct material, factory overhead, I, of course, probably need to make a change to my standards. Make sense?
Yes.
Right?
Okay.
Don't worry, I'm still drinking coffee, guys, just like I normally would in class. Just want to let you know.
He didn't say it. Okay.
Okay, so criticizing standards. Some criticism of using standard costs for performance include standards. And these are like. Well, I'll explain this. Criticism of standards can sometimes be good or bad, right? If I'm criticizing something, usually I'm using constructive criticism and I'm looking at it from that perspective. So when we use standards, sometimes standards limit operating improvements by discouraging improvement beyond the standard. Standards sometimes are too difficult to maintain in a dynamic manufacturing environment, which result in what we call stale standards. That also goes back to the reason why we need to make adjustments to our standards. Standards can cause employees to lose sight of the larger objective of the organization by focusing only on efficiency improvements. And standards can cause employees to unduly focus on their own operations and the possible harm of the operations that rely on them. So in other words, sometimes when we set standards, we are also limiting our view of the rest of the organization, and that can sometimes cause harm to the organization as a whole. So that's why we want to be mindful of when we do set standards to constantly evaluate and improve them as time goes on. So let's bring ourselves back, tie this back to the previous chapter, chapter 21. And this, we're looking at the budget again. So, because as you know, as you would think, budgets or standards also tie into budgets. And so the budgetary performance evaluation compares the actual against the budgeted. It's kind of what we just talked about a little earlier. So here's an example. So this company manufactures blue jeans. Okay, let's pretend it's Levi, right? So they manufacture blue jeans, and they use standard costs and budgets. The standards for direct materials, direct labor, and factory overhead are separated out into components. We have standard price and standard quantity. That makes perfect sense. The standard cost per unit for direct materials, direct labor, and factory overhead are computed by taking your standard price and multiplying it by your standard quantity. Make sense?
Mm-hmm.
So in other words, your standard cost per unit is equivalent to your standard price times your standard quantity.
Can you say one more again, please?
Sure. The standard cost per unit is calculated by taking your standard price and multiplying that by your standard quantity. And so let's look at that from an example. Okay, so let's say I need to make some large or extra large blue jeans, okay? So think of your clothing. Your clothing is made out of material, of course. And the material has varying sizes to it. A small shirt, a medium shirt, a large shirt, extra large shirt, so forth and so on. The same is for jeans and every other type of clothing that we wear.
Okay.
So it's just a little bit of background noise.
Okay.
So with direct materials, my cost for manufacturing jeans is $5 per square yard. Just so you all know, square yards is how materials are measured in the manufacturing process. And just to give you a little bit more background, my grandmother, God rest her soul, she was a seamstress for over 50 years. And what a seamstress does is she was a dressmaker. And so she would make like wedding gowns and other clothing, and she would also modify clothing by, making it to fit the body, right? Because we all have different shapes and sizes, yes? And so what she would do is she would measure out the amount of material she needs to make the jeans. And so it's measured in what we call square yards. I don't know if you've ever seen a yardstick before, but think of it like a super long ruler. That's the measurement of 1 yard, okay? And so the cost of the material is $5 per yard, per square yard. And in order to make extra large blue jeans, I need 1.5 yards. And so I take my 1.5 yards, I multiply that by $5 per yard, and I get $7.50 to make a pair of extra large blue jeans. That's my direct materials cost. And then I have direct labor. My seamstress, I'm paying the seamstress $9 per hour to make the pair of blue jeans. My seamstress can make each pair of blue jeans for about 80 cents per pair, okay? And so since this employee can make 80 cents per pair, I multiply that by the $9 per hour rate. It tells me it'll be $7.20 of direct labor used. Can everyone please mute yourselves? Just to cut down the background noise. Thank you so much. Appreciate it. The factory overhead, which would be like the machine that the seamstress is using, we'll say that it's the electricity and the cost of running the sewing machine is $6 per hour to run the sewing machine. Okay, and to make each pair of pants, it's 80 cents per pair. So we take the 80 cents per pair and we multiply that by the $6 per hour to run the machine, gives us the $4.80 per pair of jeans. And so to get the total cost of the extra large pair of jeans, we add up our total direct materials cost, total direct labor cost, and total factory overhead cost per pair of jeans to get $19.50 per pair of jeans. Does that make sense?
Yep.
Any questions on this?
Yeah.
Yes, but is there a certain budget that you can have if, like, let's say anything goes wrong? There's a separate budget for that?
Yes, absolutely, Joe. So there is a separate budget in the event that something goes wrong, and typically we'll create a asset account. It's kind of like our capital expenditure account that you remember from previous chapters. I think it was chapter 21. We discussed capital expenditures, and so in that account, I would typically save up in the event that there's some type of something that goes wrong. And then in the later chapter, we'll talk about if there's spoilage. If there's spoilage. Can you please mute yourselves? Thank you. Right.
Got it, Dr. B. Thank you.
Absolutely. You're welcome. Okay. So let's keep going here. Okay. So budget performance evaluation, one of my favorite topics. As you remember from chapter 21, the master budget, which is comprised of all of those departmental budgets, the master budget is prepared based on the planned sales and production. So this goes back to your earlier point on the sales part. The budget costs for materials purchases, direct labor, and factory overhead are determined by multiplying their standard cost per unit by the planned levels of production. I'll show you what that looks like here in a little bit. The budgeted standard costs are then compared to the actual cost during the year for control purposes. So just like we talked about before, in both in budgeting and of course in our planning, we compare what actually happened to the estimation, and we want to do that on a regular basis. Some companies do that annually, some companies actually do that monthly, and some companies do it quarterly. The differences between the actual and standard are called variance. So actual cost versus standard cost, the difference between the two is called cost variance. A favorable cost variance occurs when the actual costs are less than the standard cost. That's always nice when that happens. I'm always happy when I save a little bit of money. So think about it from this perspective. You budgeted your electric bill this month to be, we'll say, $200, and it actually came in at $180. That makes me happy because that means I got that extra $20 that I accounted for in that electric bill that I didn't use. So to me, that's favorable. I actually came in at less than what I had budgeted for. The same concept applies with cost. So if I planned to manufacture those jeans that we talked about earlier, let's say, for example, my at $7.50 per yard, but I was able to save some money in the purchase of the material, and it came at like $7. That would make me super happy. That means I had a favorable cost variance. An unfavorable cost variance occurs when my costs exceed the amount that I had budgeted for. And so that's unfavorable. That means I lost a little bit. So going back to our example, let's say that I used some more materials than I had planned for to make this extra large pair of jeans. And so I came in at $8 instead of $7.50. That would be unfavorable because I had planned for $7.50. Does that make sense?
Yeah.
Great. Thank you so much. Okay, so let's keep going. So this just kind of helps you with a picture, shows you favorable versus unfavorable. So think of it this way. Favorable, I'm saving cost. I did well. My actual cost came under my standard cost. Unfavorable means I spent too much. My actual costs were higher than my standard cost. Okay, so budgeted performance. The report summarizes the actual cost, standard cost, and the difference, which, as you know, is called variance, for the units produced. We call that a budget performance report. We're going to bring it all together, right? The budget performance report is based on the actual production rather than the planned production. So it's a comparison, essentially. Just as a reminder, please mute yourselves when you're not talking. Thank you.
Sorry.
That's okay. It helps us cut down on the background noise. Okay, so here's another example, and this kind of shows us what the budget performance report looks like. So going back to our example with that pair of jeans that the company was making, the company produced and sold 5,000 pairs of jeans. That's wonderful. That's fantastic, right? The actual cost incurred for direct materials was $40,150. The direct labor was $38,500, and the factory overhead was $22,400, giving us a total amount for 5,000 pairs of jeans that we incurred was $101,050. Now, if you wanted to figure out what that would look like actually, you know what? Let's do that. If you wanted to figure out what that looked like, here. Oh, look at this. Oh, we can do this virtually too, right? Okay, so what does it look like per unit? We can go, so in order to figure out, well, Dr. B, what would this look like if my total cost per unit? So we go 101,050, and we would divide that by our 5,000 pairs of jeans. And that would give me a total cost per unit during the month of June of being $20.21 per pair of jeans. Does that make sense?
Yeah.
Everyone sees how we did that?
Yep.
Cool. Fantastic. Oh, this is nice. This is working out good so far, I think. Hey, you can't go wrong. Okay, great. Thank you. Okay. So here's how it looks from the report perspective. So again, we have our actual versus our standard. You can see from our earlier example, our actual costs are higher than our standard costs, which created an unfavorable variance, right? So our actual cost came at $40,150 for direct materials. We had originally budgeted for or planned for $37,500. So what happened here? We probably purchased more direct materials than we actually used, or there was some waste that had occurred in the direct materials. Either of those are definitely possible. And so what happened is that left us an unfavorable difference of $2,650 of direct materials. Again, I actually used $40,150. I had planned for $37,500, which leaves me a difference of $2,650. Everyone sees that?
Yeah.
Great.
Yes.
Wonderful. And so we had a similar situation with our direct labor, because what it looks like is I had actually produced quite a bit, and I probably had a little bit of waste. So I also had higher than expected labor because of that. So I actually had $38,500 for labor. I had planned for $36,000, which gives me an unfavorable variance or unfavorable difference of $2,500. Now, interestingly, for factory overhead, I came in under my standard on the actual, right? So it says I came in at $22,400. I had planned for $24,000, which gives me a favorable difference or favorable variance of $1,600. So when we add all these up, I have a total unfavorable variance of $3,550. Everyone sees how we got there?
Yeah.
Great.
Yes.
Wonderful. It's a good report. I like it.
Hey, Professor.
I think there's a...
Hey, Professor.
Yes.
What situation would a company have? They would produce more. They would have more direct materials and more direct labor, but a favorable factory over. Like what scenario? How would that work out?
Yeah. So in a situation like this, so let's say I had ordered and I had some waste in direct materials, so that made it unfavorable. Direct labor, I had too many people on the shop floor than I really needed, so that made it unfavorable. And in factory overhead, my utility bills came in under what I had expected, so that made that favorable. Does that make sense?
Yeah, but how would that work out in like a real, like how can a business do that? Like, because if you had more direct labor, like if you had a actual higher direct labor than you planned for, shouldn't your factory overhead should be higher too?
No, because well, think of it this way, because Elias, so remember when we're in manufacturing, we have direct materials, direct labor, and factory overhead. The direct labor are the people that are directly manufacturing the product, right?
Yeah.
And so that from that perspective, that's how I separate the direct labor from indirect labor. Indirect labor would be covered in factory overhead, but those are typically like the shop supervisor's salary or the accounting department's salary, things like that. So in this example, it looks like I probably just used less machine hours to produce my materials. Does that make sense?
Yeah, okay.
Great.
That does make sense. I got it.
Awesome. Cool. Any other questions before we move on?
No.
Great.
Wow.
Awesome. Okay. So let's move on to cost variance. The total manufacturing cost variance is the difference between the standard cost and the total actual units produced. Very similar to what we just saw. For control purposes, each product cost variance is separated into two additional variances. So, in other words, what we're looking at here is just like in our budgets. Remember how we have the smaller budgets or departmental budgets? It's very similar to that nature. We have those other subsidiary accounts, right? And so let's take a look at that. The total direct material variance is separated into price and quantity variance. So think of price and quantity variance as our subsidiary accounts that make up the total direct materials. Okay. This is because standard and actual direct materials costs are computed by the following. To get our actual direct materials cost, we take our actual price and multiply that by our actual quantity. Okay. To get our standard direct materials cost, we take our standard price and multiply that by our standard quantity. That makes sense. Now, to figure out the difference or the variance in direct materials costs, we take our price difference, and we get that by adding our actual price plus our standard price to get our price difference. Okay. And then we add that to our quantity difference. The quantity difference is also taken by adding our actual quantity to our standard quantity. Make sense?
Yeah.
Great. Awesome. So this way we get our actual and standard direct materials costs. They might be different because of a price difference or a quantity difference, or we could have both being different, which is usually oftentimes the case.
I mean, shouldn't they be different because of their estimates? I mean, the actual thing.
Yes, yeah, you're absolutely right. So often, and that's usually the case. So because the standard is really like our estimation, and the actual is actual, a lot of times there's going to be a difference. Almost all the time, there's going to be a difference between the two. It might be very minor, but this is essentially showing us how that difference is calculated. But yeah, you're absolutely right.
Got it.
Okay. So the total direct labor. So that was we talked about direct material. Now let's talk about direct labor. And it's very, very similar. All right. Okay. So the total direct labor variance is separated into rate and a time variance. This is because the standard and actual direct labor costs are computed as the following. In actual direct labor, I take my actual rate, which is like my hourly rate. You know, my employee hourly rate is my actual rate. And I multiply that by the actual time that that employee used to manufacture that pair of jeans, going back to our earlier example. And the standard direct labor cost is calculated by taking the standard rate, which is my expected or my budgeted hourly rate, and I multiply that by the standard amount of time it would take to manufacture that same pair of jeans. And the difference would be, my direct labor cost variance or difference is the way I calculate that is I take my rate difference and I add that to my time difference. To get my rate difference, I add my actual rate and I add that to my standard rate. That gives me my rate difference. And then the actual time to the standard time, that gives me my time difference. Make sense?
Yep.
Mhm.
Yeah.
Awesome. Yep, it's very, very similar to the calculation that you made for the materials. Okay, and now last but not least, factory overhead. Remember, we always have direct material, direct labor, factory overhead. It's the same, that is our theme throughout just about every chapter in this course. The total factory overhead variance is separated into controllable and volume variances. It's exactly as it sounds like. Going back to, remember, chapter 21, our controllable costs, we talked about that. Controllable is things that we can control, right, from a manager's perspective. And the volume variance is the amount of materials and labor that are being used, right? So because factory overhead has fixed and variable cost elements, it uses different variances than direct materials and direct labor do, which are variable costs. So here's how it looks graphically. We have our total manufacturing cost variances that make up, that's like the total, right? So think of the total manufacturing cost variances as being the total of everything, yeah? That's the total of our materials cost variance, our labor cost variance, and our factory overhead cost variance. And if you break it down within direct materials, direct labor, factory overhead, we have variances in price and quantity for direct materials, variances in direct labor rate and direct labor time. And for factory overhead, we have variances in factory overhead controllable costs and fixed factory overhead volume costs. Does it make sense? Yeah?
Yep. Yeah.
Great. Awesome. Thank you. Okay. So now let's look a little bit deeper at the direct materials and direct labor variances. As we talked about, total direct materials and direct labor variances are separated into the direct materials costs and direct labor cost variances for analysis and control purposes. So here's how that looks. We take our direct materials cost variance and we attribute that to our direct materials price variance and our direct materials quantity variance. We do the same process for our direct labor cost variance. We attribute that to our direct labor rate variance and our direct labor time variance. And the only reason we do that is for analysis, because we want to separate, essentially, and it's just like what we talked about in chapter 21. Remember how we separated out the budget for our overhead, and we separated it out into direct labor and direct materials? It's the very same concept that we're applying here. So direct materials variance. Going back to our example, our jean manufacturer, we'll pretend they're actually Levi, because that's a company that I know, reported an unfavorable total direct materials cost of $2,650 for the production of 5,000 extra large jeans. This variance was based on the following actual and standard costs. The actual costs were $4,150. Our standard costs, or estimated costs, were $37,500. That gave us a difference, or a variance, of $2,650. The actual costs incurred of $4,150 were made up by the following. We had an actual price was $5.50 per square yard. And our actual quantity that we used was 7,300 square yards. So we multiply our $5.50 per square yard. That's how much we purchased the material at, right? We multiplied that by the amount of material that we used, which was 7,300 square yards. This, of course, obviously, to make 5,000 jeans, you need a lot of material, right? So we multiply the price per square yard times our actual square yards that we used in the manufacturing process to give us $4,150 of actual cost. Does that make sense? Everyone sees how that's done?
Yeah.
Great.
Yes.
Wonderful. Thank you. And so that's how we got the actual cost. To get the standard cost, again, our estimation, we estimated that we would purchase each square yard at $5, but we actually spent $5.50, so a little bit higher, right? The standard quantity, we thought we were going to use more material to actually make the 5,000 jeans. We said we were going to make 7,500. We were going to use 7,500 square yards at $5 per square yard to make the jeans, which would have been a standard cost of $37,500. So you see the difference here is we actually ended up paying more per square yard in materials by 50 cents per square yard. That adds up quickly when we're talking about 5,000 jeans, okay? But we also used less square yards total to make the 5,000 jeans. So I must have over budgeted or said that my standard quantity was going to be a little bit higher because I thought I was going to use more materials to make the 5,000 jeans. So my standard costs were $37,500. So you see the difference here is that I actually came in at $40,150. I had budgeted for, or I had said my standard costs were going to be $37,500, and so that gave me an unfavorable variance of $2,650. I hope this is a very clear example. I really like this example, by the way. Okay, any questions so far before we move on?
Nope.
Great. Awesome. Thank you. Okay. Let's keep going. Direct materials price variance. So direct materials price variance is computed by taking your actual price minus your standard price and multiplying it by the actual quantity. That gives us our direct materials price variance. But remember order of operations, very, very important when you're computing this. You see here that we have our parentheses, right? Parentheses, our brackets. We have these brackets here first. So this means do this first. Do your subtraction first before you multiply, yeah? So we take our actual price minus our standard price, we get that first, and then we multiply it by our actual quantity. And that'll give us our direct materials price variance. If the actual price per unit exceeds the standard price unit, then it's unfavorable. You know that already. Yeah, exactly. Appendix, that's right. If the actual price per unit is less than the standard price per unit, then the variance is favorable. That's exactly what you would expect. So when we're doing our journal entries for this, for the journal entry for an unfavorable variance, the positive amount is unfavorable can be thought as we're increasing our costs or debiting our costs. And the opposite is true for if our cost comes less, then we would credit our costs to reduce them. Think of them as, you remember back in Accounting 201 probably, that you had done the adjusting journal entries. It's the same concept applies here when we're doing variances. We, at the end of each month, when we were doing our variances, we would make an adjusting journal entry to reflect that change. Okay, so here's how it looks. The direct materials price for our jean company in June was computed as following. Our actual price was $5.50 per square yard. The standard price per square yard was $5. So I'll take my $5.50 minus my $5, which, as you know, is 50 cents. And we multiply our 50 cents times the actual quantity of square yards used was 7,300, which gives me an unfavorable variance of $3,650. Everyone sees how we got there?
Yeah.
Wonderful.
Yeah.
Yeah.
Great. This is working out good so far. I'm so happy. I know it's a little weird, but it's working. Okay, wonderful. Okay, so let's keep going. Now, direct materials quantity variance. We compute direct materials quantity variance by taking our, very similar, right? We take our actual quantity, we subtract it by our standard quantity. Of course, we do that first because of the PEMDAS, and we multiply that by the standard price. So remember the brackets, got to do that first. So we take our actual quantity minus our standard quantity and multiply that by our standard price. And then we do that to get our direct materials quantity variance. If the actual quantity for the unit price exceeds the standard quantity, it's unfavorable. So remember, if actual is greater than the standard, it's usually unfavorable, right? If the standard is higher than the actual, then it's favorable. It's the same process. Now, here, going back to our example, I think so, Val. I think we can hear you. Well, we can't hear you right now because I think you're muted. Okay. The direct materials quantity for going back to our example, we take our actual quantity of square yards that we used, 7,300 square yards, minus our standard quantity of yards was 7,500. That's the amount of yards I expected to use. That's the quantity I expected to use when I was making my 5,000 jeans. So I actually clearly used 200 less square foot yards than I expected, right? And so because of that, did you say anything? I think so. I used 200 less square yards, and I multiply that by the $5, which is the standard price per square yard, and I get a favorable variance of $1,000. Well, minus 1,000. Because remember, the actual came under the standard. So when that happens, of course, it creates a negative. So a negative 200 times $5 per square yard gives me a minus 1,000 favorable variance. Does that make sense?
Yeah.
Right. Any questions so
Yeah.
far? Good.
Yeah.
Everyone's good. Fantastic. Okay, keep going.
Hey, Professor, I'm sorry.
Yes, please, last.
You always multiply by the standard price?
Yes. So we multiply this by the standard price because we're looking at the difference or the variance between the actual quantity I used and the standard quantity I used. And that's because we're looking at the direct materials quantity used. So yes, in this case, we would multiply it by the standard price.
In the other one, we use the
We use the actual.
Okay.
Yep. Got it. Very good. Okay, so let's keep rocking and rolling.
I think I have a question.
Yes, please.
How do you know when you see like the difference between the actual and the standard?
Yeah, great question. So when we're looking at how do I want to put this? So as we know, for direct materials quantity, we're looking at the standard price. If we're looking at something like the direct materials price, we would use the actual, right? because it's actual minus the standard. In most cases, we're going to use actual. When we're using standard, it's because we're looking at the quantity variance instead of the price variance. So in price variance, we're going to use actual, and then in direct materials variance, we're using standard. Does that make sense?
Yes, I understand.
Also, did we already go over direct materials cost variance or?
Direct materials cost variance. Did we? We went through so much. I think we did.
You passed. Yeah, no, you passed. Yeah, cost variance.
Oh, yep.
Gotcha.
Yep.
There it is.
Absolutely.
All right, cool.
Yep, no worries. And remember, everyone, that the session is being recorded. So if you ever have questions, feel free to go back through the video and rewatch some of the parts, especially as you're taking your quiz and your homework and stuff like that. Okay, let's see. I think we left off here, was it? Okay, so the relationship. So we can see the connection between, this slide is kind of confusing, honestly, the way that's composed. So basically what this is showing us is the primary differences between actual and standard cost. So if we look at we have our actual cost here on the left side, and it's $40,150. Our standard cost was $37,500, and we can see how the actual and price and standard price makes up the difference for direct materials price and direct materials quantity. This is basically a visual representation of the previous slides. So don't focus too much on this because it looks a little messy, to be honest. But essentially what this is showing us is that the one thing I do want you to focus on is down here where it says total direct materials cost variance. To get that, we're taking our actual cost and we're subtracting out our standard cost to get our total direct materials cost variance. Does that make sense?
Yeah.
Great. So definitely you want to focus on that part because that'll come back up. Wonderful. Okay. Let's see. Just checking on the time. We've got about 10 minutes. Okay. So the direct, I just want to check real fast where we're at. Oh boy, yeah, we got to kick this thing to high gear. I'm going to focus.
No rush. No rush, Professor.
No rush. Because I don't want to spend too much time on this stuff since it's already Thursday, right? That darn extended break. Okay, this one's not as important because we actually covered that part. So I do want to cover the more important stuff. So I'm going to skip a few slides in between. So let's look at this one here. Direct labor variance. We talked about the direct materials variance. Let's talk about direct labor variance. So the company reported unfavorable direct labor variance. As you recall, it was for 2,500 for the production of the 5,000 genes. How we got there. So our actual costs for labor, or I'm sorry, the actual costs were 38,500 for labor. The standard cost for labor was budgeted for 36,000. And that gave us a variance of 2,500. How we calculated the 38,500 for the actual is we took the $10 per hour of labor, and we multiplied that by the 3,850 hours that were the 3,850 hours that were used to make the 5,000 genes to get us to 38,500. The standard or the budgeted amount that we were looking at was $9 per hour at 4,000 hours total. And so that's where the difference comes. The 2,500, that is the difference between the actual and the standard. Now let's look at the rate variance, the labor rate variance. We compute that by very similar, again, by taking our actual rate per hour and subtract it by the standard rate per hour. In our example, the actual rate was $10 per hour. We subtract out our standard rate, which was $9 per hour, and we multiply that by the actual hours used. In our example, actual hours were 3,850. And again, of course, just as before, if this actual rate exceeds the standard rate, it's unfavorable. If a standard rate is higher than the actual rate, then it's favorable. It's just like before. So the key takeaway here is if the actual is higher than the standard, then it's unfavorable. If the actual is lower than the standard, then it's favorable. Okay, so here, going back to the example, actual rate per hour was $10. Subtract out the $9 standard, multiply that by the actual hours used, 3,850, which 10 minus 9 is 1, times 3,850 gives us $3,850, an unfavorable variance. That means our actual was higher than our standard for labor, for total direct labor. Okay, so, and you can do the same calculation for time. So the total amount of hours used subtracted by the standard hours that we budgeted for, and we multiply that by the standard rate per hour. And so that's what it looks like in our example. We used 3,850 hours. We budgeted for 4,000 hours. So that leaves us a difference of, what's that, 150 hours. So minus 150 for the number of hours times $9 per hour, which is the standard rate per hour, is favorable variance of minus $1,350. Everyone sees how we got there?
Yeah.
Great. It's just as before, exactly. And here's another fancy graphic that really isn't that important. Okay, reporting direct labor variance. The production supervisor is normally responsible for controlling direct labor cost, as you would imagine. And this slide just kind of breaks down the differences that I've already explained. So again, the key takeaway here is if the actual is greater than the standard, then it's unfavorable. If the actual is less than the standard, then it's favorable. We're going to skip that. Factory overhead. Okay, so factory overhead costs are analyzed a little bit different than the direct labor and direct materials. This is because, as you would imagine, that there's a lot more that goes into it. Things like machine hours, things like that. Because factory overhead costs have fixed and variable cost elements. Just like in Chapter 21, you remember how we broke out the fixed and variable elements, and we comprise those into direct and indirect, right? And so this is what the budget report would look like. And I'm going to show you how the overhead is computed. So this just kind of shows you capacity. And you can do something like this in Excel. So for those of you who like fun stuff in Excel, you can actually estimate out based off of capacity in the factory, what would happen with overhead, right? And so, like, we have 80% capacity, 90% capacity, 100%, 110%. And we can scale up the number of units produced given the capacity and the number of hours that are taken And you can actually adjust downward, which is really cool. So, but don't worry, we don't have to do anything that crazy in this course. I just wanted to kind of show you what it looks like. Okay, so let's look at overhead. Budgeted factory overhead rates for our example company is computed by taking our budgeted factory overhead at the normal capacity and dividing that by the normal productive capacity. Don't worry, that will be provided to you in the question. The budgeted factory overhead at normal capacity, meaning I'm operating at, well, I believe it's about 100% capacity, is $30,000. We divide that by our normal productive capacity of 5,000 direct labor hours. That gives us to $6 per direct labor hour. So it's basically all we're doing here is we're taking our total amount of factory overhead that's budgeted and dividing that by the total direct labor hours that's been budgeted to get our per direct labor hour unit for factory overhead, or also known as our factory overhead rate. So for analysis, we look at the overhead being subdivided into variable factory overhead rate and fixed factory overhead rate. For the company, the variable overhead rate and the fixed overhead rate are computed by the following. For variable, we take the budgeted variable overhead and we divide that by the normal productive capacity. So we budgeted $18,000 for variable cost, divided that by the 5,000 direct labor hours, you get $3.60 of variable factory overhead rate. And the same concept applies for fixed factory. We took our fixed cost of $12,000 from our overhead, divided that by the 5,000 hours that we budgeted to get $2.40 of fixed factory overhead rate. Now, of course, we want to add those two together to get our total factory overhead rate. We add our variable plus our fixed together to get our total factory overhead rate. Any questions so far?
No.
Great. It should make a lot of sense because we went through very similar processes in chapters 20 and 21. Okay, so controllable variance. Again, looking at controllable costs, these are costs that managers have the ability to control. In this, we take to calculate the controllable variance, we take our actual variable factory overhead and subtract out the budgeted variable factory overhead. Very similar concept to before, right?
Yep.
The budgeted factory overhead is the standard variable overhead for the actual units produced. We take that by taking our standard hours for actual units produced, and we'll multiply that by variable factory overhead. And going through the same process, we take our standard hours of actual units produced, multiply that by variable factory overhead rate to get our budgeted variable factory overhead, so forth and so on. It's the very same process as before. And so we're going to skip through the examples. I think we're almost there. Yeah, we're getting there. Just a few more slides. All this other stuff, it really isn't that important that I wanted to really go through. So let's skip through let's skip through to here. So, yeah, so this talks about volume variance, the one that we're looking at right now. We would take our standard hours at 100% capacity and subtract out the standard hours of actual units produced using our PEMDAS and multiply by factory overhead rate. That would give us our fixed factory overhead variance or for volume. Going through that example. Okay. I'm going to go through 2 more slides and then we'll call it. I'm sorry that we're running a little bit over time, but I do want to get through this whole chapter today. A factory overhead cost variance report is useful for management and controlling factory overhead costs. Budgeted and actual variance costs of fixed factory overhead along with variable for each element. And let's see, I wanted to show you this on these last slides. Where is it? So it's all variance. Okay, here we are. Non-financial performance measures. So just like in your workplace, oftentimes we have what we call performance evaluations that our supervisors do on a quarterly, semi-annual, annual basis. The non-financial performance measures express performance in a measure other than dollars. So this will be such as evaluating the time, quality, and quantity of business activity. So like if I'm manufacturing extra large jeans, for example, I want to do what we call time studies. How long does it take to make each pair of jeans? What's the end result, the quality of the pair of jeans? And how many jeans can I produce in a given period of time? These are technically non-financial performance measures. And there's other ones like inventory turnover. How many jeans am I selling on a regular basis of that size? What's the percentage of on-time delivery of those jeans to the stores or to the customers? What's the time between the customers ordering the jeans to get it to the customer? What's the customer's preference ranking compared to our competitors? So like if I have Levi versus Dungaree versus, one of the other jean manufacturing companies, where does my company rank? What's the response time to a service call would be another example. Time to develop new products. This would be what you call R&D, or research and development. What's the time for that? Employee satisfaction would be another non-financial performance measure. And of course, the number of customer complaints is another non-financial performance measure. These are all ways for us to measure the overall performance of the company in addition to financial performance. Non-financial performance measures are often linked to either the inputs or outputs of activity process, like the process of manufacturing jeans, a process of sequence activities performing a particular task. And this just kind of shows us how inputs affect the activity or processes and ultimately create outputs. So, great. And that is the end of chapter 22. Are there any comments, questions, or concerns before we end our very first online meeting?
No.
I don't think so.
Great.
Oh, now I think y'all can hear me.
Wonderful. I really appreciate all of you for being here and for staying over. I hope that our very first session was beneficial. And again, this is going to be regular from now until April 6th at the earliest. My feeling is it'll probably go through the rest of the semester. I hope not, but if it does, so far so good. I think this is really good for us. And all of these sessions are being recorded. So if you think of something and you're like, oh, did we cover that or not? You can always rewatch the recording. Also, you can reach out to me by email. I'm here for you. And I'm also going to have regularly scheduled office hours as well that'll be virtual. And you can just basically drop in during that time. I'll be on WebEx. And of course, if you want to send me an email before you want some office hours, I'm here for you. So again, stay safe out there, and let's work together the best we can through these times. And if you have questions or concerns, just let me know. I'm here for you. Okay.
Thank you, Professor.
Thank you.
Thank you.
Stay safe.
Thank you, Professor.
Thank you so much. I appreciate this. Take care, all. I'll see you all on Tuesday.
Okay, sounds
All
good.
right.
All right.
All right.
Bye-bye.
Bye.
Professor.
How you end this thing? Close.
Professor.